Mark Douglas once said, trading is 100% a mental game. The reason trading is so psychological is because it has to do with money. And we all know the human emotions like fear and greed runs high whenever the matter of money is discussed. There has to be a reason trading has a low barrier to entry, because it attracts individuals that aren't skilled in this field, and the average individual are not emotionally sound with money. So the more individual they can suck into the market, the better it is for market efficiency. In the game of trading, we are competing with professionals and individuals with a lot of influence and access to coaches, skills, and technologies that will give them the edge over the average individual. You shouldn't come into this trading game without the right skills and expect to make money consistently. Imagine you've never taken a course in medicine and you are being allowed to perform an operation on a patient. It will obviously be a disaster. Or imagine you have no experience playing basketball and you are being placed on the same court with the likes of Michael Jordan, LeBron James, and Steph Curry. Do you seriously think you will score a point against these guys? Or you think you'll be able to dunk over LeBron James? Unless you're a joker, you obviously won't, because your expectations are aligned with your skill level and experience. So why do individuals come into the market and feel they'll make huge sum of money easily? We need to align our thinking with reality. Because of the low barrier to entry in trading, it attracts individuals that are not skilled in this field, and these individuals are allowed to place trade with no questions asked, simply because the market needs to be efficient in creating liquidity for the big players, which are the professionals. Note that trading is a zero-sum game, and what this simply means is that the money we lose, someone else made in the market, and the money we made, we took it from someone else. In an environment where there are professionals whose sole purpose is to collect money from the average individual, in order for us to have an edge against these professionals, we also need to develop the skills needed to play this game, and I'll talk about this here. First of all, we need to accept the fact that to reach our goals, there are a bunch of things we need to tackle and improve in between that will bridge the gap between where we are currently and where we want to be. So the first thing we need to focus on in this our journey to consistency in trading has to do with ourselves as an individual. The first problem we need to tackle is our beliefs. We need to be aware of our beliefs, but it might not be obvious to us, but there are some self-limiting beliefs that are constantly operating within us, preventing us from moving forward. The sooner we identify those beliefs and replace them with a positive one, the sooner we'll see ourselves making progress towards our goal. In my case, I had the tendency to associate current happenings with past experiences, which would now influence my response and only create what I was scared of. And bringing this attitude into trading, I found out that it's very costly. To tackle this limiting belief, I had to accept the fact that every event in both the physical and market environment are unique and random, to reduce the tendency to associate with past events, which is more likely to cause pain. On tackling this problem as an individual, the next problem now we need to tackle has to do with our relationship with money. This will determine how we handle and manage our money. If we perform poorly in this field, or if we have real money problems, we'll automatically come into the market wanting to take a win. And this would act against us psychologically and make us prone to making a bunch of trading errors that will make what we were really avoiding come through, which is taking a loss in the market. Once we've tackled this problem we have here, the next we need to focus on is our daily routines and habits. This will tell us how we are as an individual. Do we end up doing what we tell ourselves we will do, like starting that diet or enrolling in a gym membership? If we are the type of individual that end up not doing what we told ourselves we would do, we'll automatically find out that that habit has been transferred into the market in the form of us telling ourselves we'll follow our stops in a trade and end up not following our stop, and as a result incurring a much bigger loss than planned. It's not possible to be disciplined as an individual and not be disciplined in the market, or not being disciplined as an individual and expect to miraculously become disciplined in our market interaction. So we first need to develop that discipline as an individual that is automatically going to get transferred into our interactions in the market. So these are the things we need to fix: our belief, our relationship with money, and our daily habits and routine, which will build discipline. So the next thing now we need to focus on is the psychology. So what is it in this our psychology part that we need to fix? The first thing we need to fix here is we need to fix our focus. We always need to consciously focus on the process of trading well and not get worried about what the outcome is going to be. And by focusing on the process, I mean we shouldn't miss any steps or routine that goes into our trading process. And what these steps might be is our pre-market routine. That's the things we do before the market opens or before we go into our trading hours. As a personal experience, I found that anytime I get to do my pre-market analysis, the rest of my trading hours, I find this clarity on the direction I'm expected to trade that particular day. And if I don't see any opportunity trading in line in that direction, I don't take any trade for that day. Whereas in my previous trading encounters, I find myself going all over the place. Like I might come into a day without knowing what direction to trade because I didn't do my pre-market routine. And whenever I see huge movements in one direction, I end up trying to place a trade in that direction, thinking price is heading towards that direction, and price might automatically make movement to the opposing direction, and I emotionally close the trade and enter another trade, trying to catch the new market direction. So I found out that doing my pre-market routine gives me this focus and clarity and knowing what direction to trade on that particular trading day. So the next thing on our psychology is thinking in probability. The way to gain consistency in the market is to see individual trades as random and unique. By doing this, we freed ourselves from any possibility to interpret market information as threatening, and we won't feel pain on whatever outcome that presents itself in the market because our thinking was in line with reality. This is what a consistent trader focuses on. Whenever they see a trading opportunity or whenever their strategy presents itself, the first thing they do is predetermine their risks because they know the outcome is random and that particular trade might go against them. So they have to be able to accept whatever outcome happens in the market so it doesn't affect their psychology in taking the next trade. So after we've tackled the issues on this part of the psychology, we need to focus on the next, which is confidence in execution. And just like I said on this thinking in probability, it goes hand in hand with our confidence in execution. If we have no reason to see the market information in a threatening way, we won't find it hard to execute on our trade. But if we are so focused on wanting that trade to be a win, we'll be scared of the possibility that it's going to be a loss. So we might find ourselves hesitating in taking that trade because we want to be 100% sure that it's going to go in our favor before we click the buy or sell button. So thinking in probability and confidence in our execution goes hand in hand. After we've tackled the psychology part, we need to now go to the next part, which is our technical part. This has to do with the technical aspect of trading. What we need to focus on here is our analysis. This is mainly to give us an idea on what direction the market has a higher probability of moving on that particular day. We are going to find out that even though we executed on our trade perfectly, but it turns out that our bias for that day was wrong, we'll end up in a losing trade. So we need to pay attention to this as well. Analysis is very important because it gives you a clear bias for the day and it gives you where to be executing on. This is the environmental strategy we have the best chance of performing well. After we've tackled our analysis aspect, we need to now focus on the next thing in our technical, which is now our strategy. We need to have a strategy that puts the edge in our favor over a sample size of trades, and also one that fits our individual personality and the way we think or operate. Most individuals come on social media saying this strategy is better than this or this one is better than that. But the key here is to find a strategy that suits our individual personality. My strategy might be different from the next trader strategy, but it doesn't mean that my strategy is the holy grail. It's just the way I see the market and the way the next trader sees the market, and we both can be right. So after we've tackled this aspect, we need to now go to the next part in our technical, our risk management. This is a very important tool because we wouldn't want to spend all our chips on one bet. We need to be able to survive for the next bet. I read something once and then I didn't really understand it. It was a quote by an economist named John Maynard Keynes. Quote, he said something like, the market can stay irrational longer than you can stay solvent. And I didn't really understand that quote until I encountered trading and started trading the market. I realized that the market can be in a range, not going up, breaking up or not breaking down. But your interpretation of that price movement, you might feel the market will break to the upside and you might be willing to bet a huge amount of money on that price movement, or you might feel market will break to the downside and you're willing to bet huge amount of money on that price movement. But at the end of everything, the market doesn't care about our opinion or it doesn't care about what we feel. is going to do. It's going to do whatever it's going to do. So the point here is that we shouldn't bet huge bets on a particular trade idea. It's very important to manage our risks to be able to survive to come and play the next day. So after we've tackled this part, we need to now focus on the next in our technical aspect, which is our trading plan. This is what puts everything together in a way that is calculated to give us an edge over the market in the long run. And following what we've written down in this plan is our sure road to trading success. Trading plan puts together everything we've talked about in this video. It puts together our strategy, our risk management, our psychology, our execution, our focus, our pre-market routine, everything is there in our trading plan. And this is like the trader's guide. It guides the trader to consistency. The trading plan has an offensive part, which is psychology and the way we execute, and it also has a defensive part, which is our risk management to defend our balance and our money. So yeah guys, these are the key things we need to focus on each category. First, our individual part, we need to focus on some problems, which is our belief, the relationship we have with money, and our daily routines. We need to be disciplined as an individual in order to be disciplined in the market. So on our psychology aspect, we need to be able to think in probability. We need to have a clear focus. We need to be confident in our execution. The next category is our technical, and this technical involves our strategy, what we look to see in the market in order to click the buy or sell button, and our analysis, which is where we feel the market has a higher probability of going either up or down, and our risk management, which is to prevent our capital and make us be able to come and play the next day, and our trading plan, which puts everything together to give us the edge and the roadmap we need to gain consistency in trading. And I found out that psychology plays a huge role in trading success and failure. So I'll give psychology 90% of the whole thing. So gaining psychology is key, but I'll also say that you might have the best psychology and your strategy might be trash and you are not going to get anywhere in the market. But in my personal understanding, I know that learning about a strategy is very easy. It might take an individual a month or less than a month to learn everything about a strategy. But how long do you think it's going to take an individual to improve his psychology on executing on that strategy? It's going to take that individual a very long time to master himself and his psychology and to come in terms in the way he thinks and the way he's supposed to think as a trader. So that's why I'm giving trading success to psychology, because it plays the key role. Once we've gotten a technical aspect, we don't need to focus much on our technical part. We need to switch our focus on clearing up our mind and improving our psychology. So this brings an end to the video, and I hope you guys learned something from this video, and I'll see you guys on the next video. I wish all of us the best in this game, but if you don't play wisely, I'll be there to take your money. Peace.